Today I want to break down the most recent Meta sell-off. The stock dropped over 12% after earnings, and I want to go through why from a macro investor's perspective that I actually see this as a solid opportunity to start or add a long-term position into Meta. I want to talk about fundamentals, the macro backdrop, and I want to explain why my entry is here and my potential targets for the stock. So first of all, what actually happened? Meta reported its third quarter results this week, and on the surface, it looked pretty ugly. Net income dropped from around $11.6 billion a year ago just to $2.7 billion this quarter. Earnings per share came in at around 1.05, way below what Wall Street was expecting. And that headline alone sent the stock tumbling 12% and more. But if you dig in, that wasn't an operational miss. That was an accounting event. So there is a couple articles out there that kind of outlines what happened to Meta, the stock plummeting as the investors are horrified as how much Zuck is spending on the AI. And you can see here that they announced that the company will be spending 70 to 72 billion on AI, up from its previous estimate of 66 to 72 billion. That cash bonfire isn't going well for many investors. Meta shares slid more than 11% on Thursday, indicating widespread skepticism about the company's ability to stop bleeding billions of dollars as it races to keep up with the AI industry's ever-escalating expenditure commitments. Now that sounds like a lot of bad, but if you look at a couple other sites, you can even see Meta Platforms, the most undervalued Magnificent 7 stock. Meta Platforms is a compelling buy after an overdone sell-off driven by a one-time tax charge, not operational weakness. And that is what I want to emphasize here. Meta's advertising business remains dominant with other strong ad impression growth, pricing power, and robust family of apps and engagement. So this is a very interesting investment thesis, and I'm on the side of buying and holding Meta stock. As you can see, the revenue even came in at 51.24 billion, beating the estimates of 49.41 billion. Unfortunately, the stock dropped 8% in pre-market trading and overall is down around 12%. And I want to reiterate that Meta took a one-time $16 billion tax charge related to the recent US corporate tax reforms, and it's a deferred tax adjustment. It's not them paying out $16 billion in cash. Without the charge, Meta's adjusted profits would have been around $18.6 billion, around 7.25 a share, which actually beats the expectations. They're still producing over $30 billion in operating cash flow year to date and sitting on $44 billion in cash and buying back stock. So this tells me that liquidity and solvency aren't in question. So the fundamentals about this is that revenue came in around $51.2 billion, up 26% year over year. Ad impressions are up by 14% and pricing up 10%, and total daily active people across Meta's apps hit 3.54 billion. And that's over 40% of the planet using something they own every day. So even while investors are focusing on this profit drop, the core engine, digital advertising, is still accelerating. Now, yes, expenses are up because they're spending heavily on AI infrastructure and data centers. They raised their CapEx guidance to 70 to 72 billion for 2025 and said 2026 will be even higher. As a macro trader, I look at this as an investment cycle. The expansion at the same time the company's operating margins are still very healthy. Its long-term productivity play is not a short-term drag. So if we zoom out, we just had the Fed cut rates by 25 basis points this week, bringing the range down to 3.75 to 4%. So policy is shifting from tightening to easing, but slowly. For large cap tech, which is a duration sensitive, lower yields and easing financial conditions tend to support valuations as long as earnings are stable. So when I see Meta sell off double digits in a week, when the macro backdrop is softening and liquidity conditions are improving for high cap stocks, that's the kind of mismatch I look for an opportunity. In other words, fundamentals didn't die, sentiment did. Now, if we look at a chart right now, we can see Meta sitting around 647. We broke that short-term uptrend that we had since April all the way up till now. And we can see that we've broken through some support zones right here, and we have some stronger supports down below. But this is another 8.7% away and even 15% away. We're currently sitting at May lows. And if we dropped all the way now to April lows, you can bet I'll be picking up even more. If we look beyond this drop, you can see that longer term structure is still intact, higher highs and higher lows. But obviously we were due for a cool down after running more than 80% off the 2024 lows. And for me, this is where I start scaling in. My plan is to lower my cost average around this zone, and even if it continues lower, I'll be buying more. Incrementally, if we tested even around 542 or even 479, I would look for a bigger investment into Meta. Again, this is not advice, it's just my framework. Because from my lens here, Meta sits at an intersection of two huge trends: digital ad dominance and AI infrastructure build out. They already own the user attention and data, and now they're building models to serve it. So if the economy continues to stabilize and rate trends lower over the next year, companies with free cash flow and strong balance sheets like Meta tend to outperform. So when I see a company like this trading way off the highs because of a one-time accounting charge, I see a temporary mispricing pricing rather than a structural problem or an overall problem with the company. So personally, I'm not trying to catch the exact bottom. I'm layering in near the supports, near the lows with a long-term horizon of 2 to 5 years minimum. If we obviously broke these continuous lows, I'll reassess and maybe I let it base before adding more. But in general, if a company like this dips, it just lets me lower my cost average basis in a company whose fundamentals I already love. And this is how I approach as a macro trader. I identify where sentiment overshoots, the fundamentals, and the position and means for reversion. Personally, Meta has had an amazing run over the last couple of years, and I don't see it stopping anytime soon. Personally, with the AI stuff going crazy right now, I do think there could be a good pullback, especially with the valuations being very overvalued right now. But this is a stock that I want to own for the next 5 to 10 years without even selling. So I have a bunch more positions lower, and this is just giving me an opportunity to lower my cost basis instead of buying at these all-time highs. My breakdown on the Meta sell-off is pretty simple. Yes, it dropped hard, but under the surface, the business remains very strong. Tax hit was a one-time thing, and the macro backdrop actually supports the long duration in assets like this. For me, the combination of strong fundamentals, temporary panic, and technical support just equals opportunity to me. If you found this useful, make sure to drop a like and share your own levels or macro view in the comments. I'll see you guys in the next breakdown.